Hello and welcome to Professional Pensions live webinar of the latest Purple Book by the PPF. I'm James Phillips, I'm Deputy Editor at Professional Pensions, and I'm joined here today by Chief Risk Officer Stephen Wilcox and Chief Actuary Lisa McCrory.
Hello.
Thank you very much. Today we'll be talking about the latest edition of the Purple Book, looking at the landscape of the DB universe as of March last year, looking at the closest trends and what's been happening in the DB space over the last few years as well, and the key risks faced by both pension schemes and the Pension Protection Fund. We'll be starting with a short presentation on the key findings in the Purple Book, followed by a question and answer session at the end. You can start submitting your questions now. We'll make sure we get through as many as we can at the end. If you want to use the Purple Book to inform your questions, that is now available for download from the Pension Protection Fund website. This year the PPF is asking for your details. This is solely so it can find out more about you, find out how you found reading the Purple Book, and if there's anything that you want to be included in the Purple Book in future editions. So to begin with, perhaps we can start with what is the Purple Book and why is it important?
So the Purple Book is published annually by the PPF, and it aims to give a complete picture of the defined benefit universe. So they're the schemes that the PPF was set up to protect following a corporate insolvency. It has lots of useful information on scheme membership, scheme funding and investment strategy, and it gives some insights into what trustees are doing today to manage risks in their schemes. It also gives you a lot of information about us, our membership, what claims we've had so far, the levy income we've received, and then that all comes together at the end when we show some results of our modelling, what claims we might expect to absorb in the future and how our own funding is going to change. It's a really important part of our risk management framework. By understanding the claims we expect to get and combining that with our own financial position today, we can take decisions on our future investment strategy and our future levy decisions as well.
Excellent. And what are the key messages that you found in this year's book?
Well, I mean, for me, the key message is that there is still a lot of pension deficit out there. Something like 57% of pension schemes are still in deficit. Those are the that deficit position means that they don't have enough money at the moment to pay the levy, to pay the benefits that they've promised their members, and therefore need to rely on sponsor covenant. That's where our risk lies, where there are schemes in deficit. All the figures in this presentation, incidentally, will be on the Section 179 basis. That's very roughly speaking the amount that we would have to take on if a scheme came into us. It's a very convenient way for us to get figures so that they're consistent across schemes and understand the impact on us of any claims that may happen. The deficit adds up to about £160 billion. That's a large number. Now, clearly, when you look at the universe as a whole, there are schemes in surplus which somewhat offset that, and quite often the headline figure combines those. But for me as CRO, what I'm really interested in is the risk position, and the aggregate risk position for us is that 160 billion as it was at March last year. We do update this every month and publish it in the 7800 index. The latest figure was about 185 billion. It's quite a volatile figure. The other important thing to remember is that it is quite a large number. You compare it against our reserves of 6 billion and you can see that the aggregate risk we face is quite a lot bigger. Now, that doesn't concern me because there is a lot of diversification in the universe. We don't simply expect to have to absorb that deficit all at once, and we reckon that that £6 billion of reserves we got is about the right number for us in our current state in order to protect us and the members of schemes against the risk of claims on us.
Sure. How does the data in the Purple Book this year compare to the 2018 edition?
So it's good news. The funding position has improved over the year. It's increased from 96% to 99%, and that's where we're looking at all schemes in our universe, not just the ones in deficit that Stephen was chatting about. So the big reason for the change came about because we changed the assumptions we used to value our liabilities, and that was really to reflect the fact that buyout pricing is much more competitive compared to what it was. So that improved funding by around 5%. Market movements also have an impact, and this year both assets and liabilities increased, but unfortunately the assets didn't keep pace with the liabilities, which actually reduced funding by around about 3%. And then finally, each year we get new data from the pensions regulator, and when we updated our calculations for that, that also improved funding slightly by about 2%. And really all that's telling us is that scheme experience was a little bit different to what we assumed when we did the calculations last year.
Yeah, okay. And is the data that you're seeing, the movements in the data, are they consistent with previous years?
I think when you look at how funding has moved over time, the most notable feature is that it's been very, very volatile, and we've seen some very big shifts in funding in very short time frames. Also, what's quite interesting is the funding position today is not actually that different from back in 2006 when we started. It was 97% then, it's 99% now. However, the good news is funding has been improving and has been trending upwards and has been a lot less volatile than what we've seen in the past. It's also quite helpful to look at funding by subsets of our population, and in particular if we look at overfunded schemes relative to underfunded schemes, we can see that overfunded schemes have been a lot less volatile, and that's really just a feature of their investment strategy. The well-funded schemes tend to adopt a less riskier approach, and in fact it's actually very pronounced a difference. Overfunded schemes have 70% of their assets in bonds, which compares with only 25% in the worst funded schemes.
Excellent. As we're talking about subsets, is there anything that's different for schemes of different sizes, for example?
Absolutely. I mean, the funding position of schemes of different sizes does vary quite a lot. We can see from the data that particularly when you look at the smallest size of schemes, the very small under 100 schemes, and the largest, the over 10,000 schemes, those actually have a majority of members sitting in schemes which are overfunded, and the number of people sitting in schemes which are overfunded generally, whatever the size, is quite reasonable. And as we can see from the data when we compare it to what we saw when we started, quite a lot more, quite a larger proportion of members are in that overfunded position than they were back in 2006. However, if we look at the other end of the data, the schemes which are significantly underfunded, and by significantly underfunded in this context, I mean schemes which are less than 75% funded, there are still quite a lot of people facing that situation. If we start with the smallest schemes, these are the schemes which are likely to have the weakest covenant, so they're less likely to be able to rely on the protection of sponsors. There are something like 200,000 people still sitting in schemes with less than 1,000 members, which are less than 75% funded. And those people contribute towards a deficit of about £12 billion in those schemes. So that's quite a large deficit sitting there in what's probably one of the riskiest parts of the universe. However, if we move up to the larger schemes, we're still seeing that same quite large underfunding position. We're estimating that actually the proportion of people sitting in schemes which are significantly underfunded, even amongst the largest schemes, has actually gone up over the period of our existence. So there are some interesting things going on there. It's important to remember, of course, that a larger proportion of what's currently a smaller base can still be quite a large number of people. In aggregate, the size of the universe has gone up a lot over the last nearly 15 years that we've been in existence. So the risk to us has increased a lot over the time from this underfunding. Nevertheless, I think we're probably in a better position now than we ever have been in the past to deal with that risk of underfunding and risk of claims on us. We're much larger, which obviously gives us intrinsically more resilience. We've got much more experience in dealing with claims. Our processes are much better and much slicker. And we've got a £6 billion reserve. All of that adds up to, I think we're pretty well protected. However, there is still risk out there that we need to be very aware of and alive to.
Excellent, thank you. This is just a reminder, of course, there is an opportunity for questions at the end. We've got a couple in already, which is great to see. We've got a few more things to discuss, and then we'll make sure we get to them. So perhaps we can move on to, with all of this in mind, all the data that you've seen over the past few years, how do you expect the scheme funding situation to change in the future?
Well, that's quite a difficult question to answer. Our central assumption is certainly that funding will continue to improve over the longer term as employers continue to pay in their deficit reduction contributions. It's far from certain, however, and if we look at the investment risk that exists within the schemes, I think that's one of the most notable trends in the Purple Book. That's changed a lot over the last 14 years. In particular, we've seen a slow but gradual shift out of the equities into bonds. Back in 2006, there was 70% of assets in equities, and that's fallen down now to 25%. But that's still quite a bit of risk. So, for example, even a 10 basis point change in gilt yields can move funding by £20 billion. And to put that number into context, we would need to see a 5% change in equity values to have a similar impact. And we've already been talking a little bit about how underfunding and investment risk is correlated. So them schemes that would claim on the PPF following a sponsor insolvency are also the schemes that are more vulnerable to market movements increasing their deficits in the future.
Of course. Investment risk is, of course, just one of the risks faced by schemes. What kind of other risks have you been watching, and what other developments have you seen there?
Sure. I mean, there are two de-risking elements I'd like to talk about. The first is the de-risking which happens when schemes close, either to new accrual or to new members. Lisa mentioned a correlation between underfunding and investment strategy. There's also a correlation between underfunding and the status of schemes. Open schemes tend to be less well funded. So, over time we have seen more and more schemes close to new members and to new accrual, but still 55% of schemes have some sort of openness, either open to new accrual or to new members. And that 55% does increase risk, because open schemes of any kind tend to be riskier than closed schemes.
Excellent.
The other kind of de-risking I wanted to talk about is one that hits the headlines quite regularly, which is transfers to the insurance market. Over the last few years, we've seen the amount of transfer to the insurance market, either via buy-ins and buyouts or via longevity swaps, increase quite consistently, except there was a spike in a particular year due to some particularly large deals. When we cut the data about the middle of last year, we were estimating about 17.5 billion to that point. The estimates we've seen for the full year are around 40 billion for the whole of 2019. The best estimates we've seen are that it will continue at that level, or perhaps slightly less, for the foreseeable future. Now, it's important to remember that transfers are not a solution for everybody. They are transfers to get the protection of insurance capital, and insurance capital is not infinite. There is a supply side constraint on risk transfer deals. The other thing to remember is that £40 billion, although it's quite a large amount, is actually relatively small as a proportion of the 1.6 or 7 trillion of assets and liabilities that sit in the pensions universe. And that's just the universe we protect. There are other pension funds we don't protect. And so it will take quite a number of years of 40 billion of transfers to make a significant dent in that total risk exposure. The other thing, of course, is that the schemes who are able to do these risk transfer deals are almost by definition the least risky. They either have well-funded positions themselves or have good access to very strong sponsors who are able to fund that risk transfer deal. So actually the impact on the PPF itself of risk transfer deals is relatively slight, because it's taking out the least risky schemes from the universe.
Excellent. Okay. What does this all mean for you at the PPF in terms of your risk and your funding position?
Sure. So we estimate, as I said, that we are at the funding level we want to be at. We're estimating a 90% probability of success or thereabouts. That is where the board wants to be at the moment. So there is a 90% probability that by the time of our funding horizon, which we're currently estimating around 2030, we'll be at least 110% funded, and that is enough to mitigate the risks we face. Now, that's a mathematical projection. That's based on a number of assumptions. It's based on assumptions, essentially, that we don't change our investment strategy or our levy strategy between now and the funding horizon. Now, clearly, we manage ourselves continually from day to day, and we respond to changing circumstances as they emerge. But from a modelling perspective, it's a decent base assumption to make. There are two particular developments I want to update you on at the moment in our modelling environment, which I'm quite excited about. The first is that we are moving the mathematical model that underlines our projections from its original platform onto a new responsive fast platform. This will enable us to get results much, much more quickly, and therefore will enable us to have much more granular access to the data to understand what our projections are telling us about the future in much more detail, and also to have much more timely access to modelling results when things happen. The other development that we're going to be undertaking within the course of the next 2 years, which we announced in our strategic plan last year, is that we're going to fully review our funding strategy for the future. We think it's the right time for us to do this now, as we have got to where we've got to in our development, and as we've got the time now between now and our funding horizon. So those are two quite important things for us for the future.
Excellent. And of course, the Purple Book has tons of data in there for everyone to read. But from your perspectives, what are the key takeaways from this year's edition?
I think for me, it's really the continuation of the trend on investment strategy and that substantial de-risking that we have seen. That's good news for us at the PPF.
For me, it's the fact we are still 90% likely to meet our funding targets by our funding horizon. That's good news. It illustrates our strength. But also, it's really important to remember that there is still a lot of risk in the universe. There is still 160 billion of deficit. That's quite a volatile number. And as we've said, it's the schemes in deficit which typically tend to have the riskier investment portfolios. And within that 160 billion of deficit, there are some interesting trends that we're perhaps beginning to see come out, depending on the type of scheme we look at. So there's a lot of rich data there, which we are continuing to look at and understand so that we can understand our risk better.
Thank you. Well, that brings us to the end of our formal discussion, which means, of course, we're going to start with questions from the audience now. Thank you for everyone who submitted so far. And there are quite a lot of questions here, in fact. One theme that seems to be coming up, and I know that you've covered this in the Purple Book, is how you've thought about the key risk developments that you're faced with, and the schemes in the DB universe are. One of those is Bauer. Would one of you want to talk about how you've considered that so far?
Okay, so Bauer reconfirmed that members should receive as a minimum 50% of their accrued pension, and we believe the methodology that we've been working on will deliver that to our members. There were other aspects of the judgment as well that we continue to work through with the Department of Work and Pensions. But our analysis to date shows that the impacts of that are most likely to be operational rather than financial.
Excellent. And of course, one other topic we could not go without talking about, 2 weeks away from it now, Brexit.
Yes, Brexit.
What are the latest developments from your end on that?
So obviously we've been monitoring the political situation very closely. We do seem to be closer to a political to knowing the political end game. When Brexit was first mooted, obviously we started looking at what it might mean for us. We are mainly a UK institution from an operational perspective, and therefore our operations are relatively insulated from the potential impacts of some fairly extreme Brexit scenarios. But we do have members overseas in various parts of Europe, and we have looked at the operational impact of Brexit, and we're comfortable that we are able to continue servicing those members in the way that they'd continue expecting. From a financial perspective, we've tried to understand the potential impact of Brexit and other potential economic scenarios on us. Broadly speaking, I think we are reasonably well positioned to respond. Within the modelled scenarios, we have some fairly extreme ones, and we're able to respond to those. Now, the other thing we've obviously had in the last few months, as Lisa was talking about, is Bauer, and in preparing for possible Bauer outcomes, of course, that's helped us understand what we would need to do if some very extreme scenarios hit us. But for me, those are relatively remote scenarios.
Of course. And in looking at all those issues, you've also done your own stress testing, haven't you? Which look at the most extreme, or some of the most extreme circumstances that you could face. Could you talk a little bit about what you found so far?
Sure. So there are some illustrations in the Purple Book of some of the stress tests we've undertaken. All financial institutions, as a matter of routine, will do stress tests and scenario tests because it's a very good way of understanding the impact of the crystallisation of various risks on your operations and your finances. The PRA, as you may know, publishes stress tests which it asks the institutions it regulates to undertake and report back to it. We're not regulated by the PRA, but we've adopted the PRA stress test as one of our stress tests. And because it's a relatively short, sharp shock scenario, we're relatively well protected from it. We're in the privileged position that if we become underfunded, we don't need to go out and raise capital like a regulated financial services institution would need to do. On the other hand, we've then used that PRA stress test as the basis of some more extreme stresses, and we've deliberately gone for some fairly extreme scenarios in order to understand what extreme scenarios might have a real major impact on our finances. The sorts of things we would be facing in those circumstances would be very prolonged periods of both low interest rates and very weak investment returns or negative investment returns, which would not only affect our own finances, eat it away at the growth we need in order to protect, in order to recover from underfunded claims, but would also, we think, dampen the resilience of sponsors and also weaken the finances of pension schemes, and therefore make it more likely that we'd have more claims and larger claims. Now, as you said, we think those are fairly extreme scenarios we've modelled, but we think it's important to understand those. So our central position is still that we think we're 90% likely to get where we want to be by the funding horizon.
Great. Okay, well, thank you very much. And sorry, just to remind you again, there is still opportunity for you to submit your questions. You can download the PPF's Purple Book on their website now, and they will be collecting your details, but solely for the purpose of finding out more about you and what you want to see in the Purple Book in future editions. So I'm going to go turn to some of our questions from people at home or in the office, wherever's most comfortable for them, I suppose. How do you expect the change in your credit rating provider to impact the risk faced by the PPF and the levies collected by the PPF?
Shall I talk about the risk, and Lisa, perhaps you talk about the levy, if that's all right?
Okay.
So, frankly, from a risk perspective, it won't change anything. It's a measurement of risk. It's not actual risk. So, as people will know, we're moving from Experian to Dun Bradstreet for our levy calculations. In the background, in my team, as we understand risk, we use all sorts of measures from all sorts of credit rating providers. So, it provides us with a different and new source of information about the risks we face. It doesn't actually change the risk profile at all.
And in terms of the impacts, we're now consulting on our new levy model. Consultations open until February, and there will be some change in scores relating to how the data feeds into the model. And there will be some information on that in the consultation document. Schemes will then have an opportunity to clean their data, and then we'll see what the final impacts will be.
Sure. Okay. And staying on the topic of risk, there's been a broad change in a DB and DC universe, in fact, and a lot more focus on ESG and climate change. Yeah. What is the PPF doing in light of the climate change issues, or what kind of exposure do you think that you have?
Sure. So you can go onto our website and read our statement on responsible investment. We have within our investment team a team of responsible investment experts who are busily going through our books and understanding what that risk looks like to us. Going forward, one of the things we would like to do as an organisation is widen that out. We would like to understand the impact of the PRA's ESG stress tests on our books. So again, we're going to adopt some of the practices that regulated financial institutions have adopted.
Okay. What kind of impact do you think the ageing DB membership will have, and longevity trends that we've seen over the last decade that seem to be reversing or increasing again?
Yeah, it's a difficult time for longevity at the moment. Certainly life expectancy is continuing to improve. We have seen a slowdown in recent years. However, the 2019 data has kind of reversed that trend slightly. We're watching with interest. We regularly stress our balance sheet and to understand what it would mean should experience be different to what we expect. And part of the reason we try to target this margin above our expected outgo is to protect us in case life expectancy does turn out to be different to what we have assumed.
Yeah. I mean, from a risk perspective, longevity is a very interesting one because it's a very, very slow burn risk. We're not going to know the final outcome really until the very, very distant future. The list of our biggest risks we published in our annual report and accounts last year, and longevity is on that, as you'd probably expect. It is, as I say, very, very slow burn, but it is one that impacts not just us, but also the pension schemes that we protect. So it's one we monitor, as Lisa said, continually to make sure we understand it and to make sure we understand the trends.
And at the moment, it's not our biggest risk, is it?
No.
But it will become more of an issue, particularly post our funding horizon.
Speaking about that funding horizon, there are a couple of questions in here about, in some of your most positive scenarios, you'll have a surplus by 2030. Are there any plans on what you might do with that surplus?
Well, I think if we get to 2030 and we do have a surplus, I'll be very pleased. We'll have done a good job for our members. There's still a long time ahead post 2030. In fact, our pension outgo will continue to grow for a number of years after that. So the risk we face, there will still be some. We've just talked about it. One of the bigger ones, the longevity risk. So yeah, we do consider what we would do in them circumstances as well, and there are options available to us. I see it very much as part of my job to make sure that not only that we have enough money, but we don't have too much money as well. And Stephen talked about our plans for reviewing our funding strategy and what that might mean in the future as we approach our funding horizon.
Yeah. One of our eagle-eyed viewers has spotted that you were expecting an extra $2 billion in extra claims by 2030 than you were 2 years ago.
Gosh.
That
is eagle-eyed.
Yes. What do you have any way that you can? Why do you expect this? I suppose is the question.
I think we'd need to go away and dig at the underlying stats, to be honest, to do that. Models are models, and we refine our models all the time, and we update our models periodically. I'm very happy to go away and have a look and see if we can come back with a more positive answer than simply that, I'm afraid.
I mean, one of the things I noticed as I was reading through is that the insolvency rate of companies, of sponsors of DB schemes, seems to be lower than the England and Wales average.
Yes.
What do you think the reasons are behind that?
It's very difficult to tell. The data on insolvencies is pretty sparse. The granularity is pretty sparse, and our universe is small, and therefore analysing our own universe is a difficult job. However, we do think that our universe will tend to be less risky than England and Wales as a whole, because if you look at England and Wales as a whole, it will include things like personal service companies, it will include SMEs which have never had pension schemes, have never had DB pension schemes, and so are not in our own universe. There is also a certain amount of survivorship bias in our universe, in that weaker companies have already gone insolvent, and therefore companies which have survived the last few years of relative economic stress are reasonably strong. But yeah, we carry on looking at the credit exposure, we carry on looking at the credit risk in order to understand it, and in order to understand better what might happen in the future.
Yes. Okay, another question we have here, and I think you kind of touched upon it earlier when you were talking about how the least well-funded schemes tended to have the riskier investments. How vulnerable do you think those schemes are to an economic shock?
It's very difficult to quantify that sort of risk in that sort of micro universe. Clearly a scheme which is underfunded, which has a strong equity, a large equity allocation, potentially has a weak sponsor, is more likely to claim and to have a larger claim after an economic shock than one which is more defensively positioned and has a stronger sponsor. I couldn't possibly put a number on it, but I think that's the general message, that the correlation between the stronger schemes, the stronger sponsors, the better funded schemes is quite high, and there does appear to be the beginnings of a suggestion there might be a split between those stronger schemes and those weaker schemes.
Yes, and in particular the small tail of the tail of small underfunded schemes. Is that a particular concern for you?
It's certainly something we are keeping an eye on, absolutely, yes.
Okay. What kind of, you talked about, obviously, in one of your earlier slides, about the trend in risk reduction, buy-ins, buyouts, and those generally being taken up by the better funded schemes. One of the other solutions we haven't talked about, which is yet to emerge on a large scale, is consolidation. Yep. What are you doing in this space? How do you view consolidators?
Sure, so consolidators are a potential solution to aggregate schemes, whether those are underfunded schemes, adequately funded schemes, schemes which need to streamline their operations. It's a potential solution for that. We're working very closely, as you'd imagine, with our colleagues at the pensions regulator, and we're supportive of the work they're doing to ensure that consolidators are able to operate, but in an appropriately regulated and an appropriately controlled way. Consolidation is not the only solution out there, but it is a potential solution for schemes which are facing those potential difficulties.
Okay. Thanks to everyone who has submitted questions so far. I've got through quite a number of them, but there is still plenty of time for you to submit some of your own. Please just use the question ask a question button just underneath the video on the webpage. Another of the findings I found particularly intriguing in the book was the number of schemes using contingent assets had fallen, and this seems to be a trend that's been going for a few years. I know that some of the benefits of using contingent assets actually can lead to a lower levy rate for some schemes. What do you think the reasons behind this are, and do you have any messages you might want to say about contingent assets?
Say there's probably two reasons we feel that the number of contingent assets have fallen. Firstly, the move to Experian would have moved around some of the scores, which meant that some employers and their sponsors were now in the same levy band, so it was less beneficial to submit a contingent asset. And then on top of that, we've also changed the way we administer these, and we need to receive evidence to document that the contingent asset is going to be valuable on insolvency. And it's possible that some schemes now believe it's not worth the effort, or they'll not get the returns from submitting as a result of that. But clearly, anything that reduces risk in a scheme and gives members more chance of receiving their full scheme benefits is good news. So we continue to support and welcome contingent assets.
Sure. Okay. Are there any other, moving back to investment risk, are there any other geopolitical risks that you've got a particular eye on?
Our investment portfolio is global. We keep an eye on the world
Yeah.
and try and, thankless job I suspect, but try and make sure that we understand as best we can the risks that anything in the world might pose. Now, clearly, if you have a global asset portfolio, quite a lot of it's in the US, so we're keeping an eye on what's going on in the US. Now, that's no more than simply saying, what is it? What might the future look like? If the future is a particular way, what might that do to our finances? And underlying some of the stress tests we talked about was the suggestion of some global economic turndowns. Our investment portfolio is well diversified. We are well protected by our LDI strategy from rapid fluctuations in interest rates, and we showed the chart of our own funding level, which has been much less volatile than even the overfunded schemes funding level because of that strategy.
Yes. Okay.
I would also add on to that that we do hedge a lot of our inflation risk, and we do so using RPI instruments, although our benefits are linked to CPI, so we're following the developments in that market as well.
I'm sure. Yes, we've got that consultation to await, and I'm sure you
Yes.
can't talk about that now. Another question is on the length of the recovery plans, which again you've seen another gradual decreasing those length. What do you think that's an indicator of?
I think it's an indicator that sponsors are trying to plug some of their deficits. We look at it on a 3-year cycle to tie in with the annual valuation cycles of schemes. You could argue it could come down a little bit quicker given the 3-year length of plan, but it is certainly good to see some movement in the right direction.
Excellent. The top levy payers, this is a question, I'm just going to quote it because it's probably easier. Top levy payers account for 50% of the total, top 100 levy payers, account for 50% of the total levy, and this is higher than it has been previously. Do you think this is fair?
Well, some of the big schemes do pose a risk to us still, and if you looked at some of the funding charts by size of scheme, there are still some overfunded scheme or some large schemes that present a potential high risk to us. When you look at levy as a proportion of assets, it is comparable, and in fact, nobody will pay more than 0.5% of their liabilities.
I mean, I hope your colleagues are showing the chart that we can see on the screen, and you can see that 40% of members in the largest bands, people sitting in schemes of with more than 10,000 members, are underfunded. Those are the schemes which pose risk, and our levy is intended to be risk responsive. And we can see, comparing the position to 2006, actually that hasn't changed a great deal since 2006. So our levy, as a risk responsive measure, goes where it sees risk.
Of course. Okay, we've probably haven't got much longer for questions now, so if you've got anything that you're burning to ask Lisa and Stephen, please do submit your question. I've got one more here. It's about, I think this ties in perhaps with the work that TPR is doing on trusteeship. Is there anything that you're concerned about some trustees maybe taking lower risk or taking more risk and lower cash contributions in a bid to kind of improve their relationships with their employer?
It's not something I've looked at a lot in detail. Okay. I guess for our own schemes, we have our panel of trustees that we work very closely with to make sure that the best outcomes for members going through the assessment period.
We work very closely with TPR all the time, but questions about trustees and regulation trustees are really for them, not for us. We're here to protect schemes rather than to regulate schemes.
Excellent. Well, in that case, I think we have managed to get through all of the questions the audience has put. So genuinely, if you've got one more, get it in. We'll probably oh, there we go. See, one just came straight through. This is quite a technical question, actually. Are you planning on using artificial intelligence at all to manage your risk?
Shall I start on that one?
Yeah.
Artificial intelligence is an interesting one. It's not something that we're actively exploring. I'm thinking about the potential uses of artificial intelligence. I wouldn't want to put words into my colleagues' mouths, but I can see other places in the organisation where it might be of more use than in a sort of risk scenario. We do use a lot of statistical analysis, and essentially artificial intelligence is automation of statistical analysis. At the moment, I prefer to use human intelligence to interrogate the statistics that come out of that statistical analysis.
Excellent. What is the one risk trend where the PPF would like to see something different in next year's book?
That's a good question.
That's a very good question, isn't it? I think I would like to see faster de-risking. That is happening, but it's happening quite gradually. In order for us to do our job, which is to protect members and to protect schemes, the less risk there is out there, the better we're able to do that job. I'm not like an insurance company who wants to write lots of business. If we never get a claim, that makes me happy. But because that means that members are getting what they've been promised by their schemes rather than having to rely on us. Now, having said that, of course, we are always going to be there for the schemes which need us. We will always be in a position, I suspect, where there are claims.
Yeah.
I would say for me, it would probably be deficit reduction contributions. It would be good to see more money going into pension schemes and some of them deficits that have been persistent for a while disappearing.
Of course, yes. They're flooding in now. It worked. The average insolvency rate, we'll go back to that.
Yeah.
The average insolvency rate in the PPF universe did fall this year.
Yeah.
What do you expect that trend to be like this coming year or the next few years, or is it too early to tell?
Predictions are a mug's game in this business. We do model things. We are monitoring insolvency trends. For various reasons, we suspect insolvency trends will tick up a little bit. Now, how much they will tick up, I don't know. But as always, we will stand ready to respond to claims as they come in, and try and understand the risks we face as best we can.
Of course. Okay, well, I think actually, excuse me, sorry, call it a day there.
Okay.
But if I can ask before we finish, if you've got any final thoughts that you might want to mention, maybe Lisa, shall we have any?
I guess it's been an interesting year for us with the buyer judgment, and as Stephen said, that has led to us doing a lot of analysis on our financial resilience. Our balance sheet remains robust, and so we're in a good place to protect our members going forward.
Excellent. Stephen?
I think I'd reinforce what Lisa said. I said earlier there are some interesting trends coming forward, but we are in a good place, both financially and actually operationally. Operational resilience, as it is in the whole of the financial services sector, is something we take very seriously, and we need to make sure that whatever might hit us, we are ready for it when it comes, and we are resilient to that. So that's, for me, going forward, what the important things are.
Excellent. Well, thank you very much, Lisa and Stephen, and thank you everyone for tuning in and providing your questions. Just before we finish, again, just a reminder that the Purple Book is available for download on the PPF's website. They are asking for your details this year. This is so that they can find out more about you, find out what you like about the Purple Book, and also find out what you would like to be included in future editions. This is really your opportunity to feed in to how that book is compiled in the future. I thought that was a very interesting discussion. There's certainly lots of data to review there. So thank you, Lisa. Thank you, Stephen. And thank you for everyone for tuning in. Thank you. Goodbye.